Before this video ends, I'll show you the hidden signal in Dubai/Singapore silver $91 versus $74 gap plus COMEX drain and why the obvious interpretation is wrong. Dubai/Singapore silver $91 versus $74 gap plus COMEX drain looks straightforward, but the real story is disbelief and most viewers are missing the move. The latest numbers, timing, and catalyst chain point to something that does not line up with the lazy headline version. Dubai/Singapore silver $91 versus $74 gap plus COMEX drain. Overperformers combine volt drain with physical premiums. Time to late April delivery logistics and refinery shipments. Data-heavy charts packaging repeats past winners, and the viewer needs the hidden implication before the market catches up. By the end, the viewer should understand why Dubai/Singapore silver $91 versus $74 gap plus COMEX drain changes the next move and what to do with their own position. The key question is, what changes first? And that answer is not where most people are looking. Translate the setup into what it means for a physical stacker with a real ounce count, not just market commentary. The title promise here is simple: alert hides chart. So let me show you why those words are not clickbait in this case. Here is the frame for everything that follows. In the East, buyers in places like Dubai and Singapore care about bars they can source, move, refine, and settle now. In the West, the benchmark most people repeat is still tied to futures, ETF flows, and promises of delivery later. Those are not the same thing. When physical demand becomes urgent and specific, the East tends to reveal the real clearing price first. When paper liquidity is deep and convenient, the West can look calm even while the physical market is tightening underneath it. That is why this matters right now. On April 10th, 2026, the late April delivery schedule and refinery shipment window into April 29th, 26 can act like a stress test for the entire silver market. If the bars needed in the East keep getting bid away while Western pricing stays anchored to paper, the spread can persist longer than most traders expect. That is the contradiction. One metal, two prices, and the side touching actual bars is the one paying more. Chart 1 is the headline nobody can ignore: roughly $91 silver in the Gulf and parts of Asia against roughly $74 silver in New York pricing. Even if those exact prints move day to day, the message is the same. The East is willing to pay a real premium for immediate metal, while the West is still advertising a cheaper price based on a more financialized market. Chart 2 explains why that matters. A geographic spread is not just a weird regional quirk when it shows up during a physically sensitive window. It is a signal that the benchmark most people repeat may be lagging the market where real ounces change hands. And notice the emotional trap this creates. Western traders see $74 and assume silver is calm, or maybe even cheap enough to delay action. Eastern buyers see $91 and assume the opposite: secure the ounces while they can still be sourced. One side is anchored to the screen, the other side is anchored to settlement. When you understand that, you stop asking which region is crazy and start asking which region is revealing the true cost of metal in hand. What this means for you is simple. If you own 25 ounces, the difference between a $74 pay-per-view and a $91 physical clearing view is $425 of hidden value. If you own 50 ounces, that spread becomes $850. If your bag is 91 ounces, the math becomes $1,547. On 100 ounces, it is $1,700. That is why this is not just market trivia. Your stack can be priced by two different realities at once. Now chart 3 is the vault story, and this is where the West starts to look vulnerable. The COMEX drain narrative is not a small drawdown. The setup we are tracking points to roughly a 78% draw from prior vault levels, which means the cushion is dramatically smaller than it used to be. People hear that and say, fine, there is still metal in the system, but that misses the point. Tight markets do not break because the last ounce disappears. They break because the easy ounce disappears. The bar that is already in the right form, in the right place, available at the right time, is always worth more than the bar that technically exists somewhere else in the chain. Chart 4 sharpens that. When vault inventories shrink and buyers in the East are still accumulating, every remaining ounce has to do more work. It has to satisfy futures confidence in the West while also satisfying physical urgency in the East. That is where paper suppression, or at minimum paper lag, becomes dangerous. The West can keep printing a tidy benchmark as long as enough people accept claims instead of insisting on metal. The East does not care about that convenience. It accumulates physical bars, kilo bars, refined product, and immediate settlement inventory. That is why the East often exposes stress first, while the West keeps acting like nothing is wrong. This is the part where many people make a category error. They think a big vault number automatically means easy availability. It does not. Availability is a function of willingness, location, form, and timing. If the wrong silver is sitting in the wrong place while the right silver is being demanded somewhere else, the market behaves as if it is tighter than the headline inventory number suggests. That is exactly how a spread like this can survive longer than people think it should. What this means for you is that the quality of your ounces matters as much as the count. If you hold 10 ounces, your decision is mostly about whether you want exposure before the spread gets noticed more widely. If you hold 50 ounces, you are already big enough that a delayed Western repricing can materially change your cost basis versus replacement cost. If you hold 100 ounces or more, you are no longer just watching spot. You are watching whether physical access starts getting priced separately from paper access. Now, Chart 5 is the part many people ignore because it sounds boring until it suddenly is not. Logistics. Late April delivery scheduling and refinery shipments are not background noise this month. They are the calendar mechanism that can keep the spread alive. A futures market can imply calm, but bars still have to be poured, moved, insured, cleared, financed, and delivered. If refineries are already allocated, if shipment timing narrows, or if the preferred bar format in one region is not the bar sitting in another region, the market develops friction. Friction is where premiums are born. This is especially important in silver because the market likes to pretend all ounces are interchangeable until the day they are not. A wholesale bar in one location does not instantly become the exact product another buyer wants somewhere else. There can be conversion, delay, scheduling, and trust costs layered into the chain. That is why a region that is physically accumulating can pay more even while the headline benchmark somewhere else looks sleepy. The East is not bidding against the screen. It is bidding against time. Chart 6 builds on that. Imagine the West saying silver is cheap because the quoted benchmark looks soft, while buyers in Dubai and Singapore are effectively saying, we do not care what your screen says, we care what it costs to secure metal now. That is not a theory clash, that is a settlement clash. One side is pricing optionality and leverage, the other side is pricing certainty. In normal periods, those two stay close enough together that people pretend they are the same. In stress windows, they separate. That separation is the entire story of this video. What this means for you is that replacement cost can outrun headline spot faster than people expect. If you plan to add 25 ounces later because the screen looked favorable, a physical premium can erase that comfort. If your target is a 100 ounce bar, you need to think less like a paper trader and more like a buyer competing with a logistics queue. If you already own 250 ounces, the question becomes whether your stack is underappreciated by Western benchmarks right now. If this breakdown is useful so far, hit like because this is exactly the kind of silver setup that gets misunderstood until the move is already underway. Now we can resolve the open loop. How does a $91 East price and a $74 West price actually come back together? There are only three ways. First, New York rises toward the physical reality. Second, Eastern premiums cool because the delivery stress eases and the bars show up where needed. Third, paper claims in the West lose enough credibility that the benchmark has to reprice abruptly. The most likely answer is not one clean event, it is a blend. The East keeps bidding physical, the West keeps lagging, and then the Western benchmark catches up in steps once the market can no longer ignore replacement cost. That matters because many viewers still assume a spread like this must instantly arbitrage away. In textbooks, yes. In real metal markets, no. Arbitrage requires transport, timing, trusted counterparties, conversion between bar formats, financing, and the confidence that the spread stays open long enough to cover the friction. If the East is absorbing physical ounces faster than the West can redirect them, the gap can persist. That is why the late April schedule matters so much. Between now and April 29th, 2026, the market does not need a cinematic squeeze to send a signal. It only needs enough pressure that physical metal keeps clearing above paper expectations. And here is the important nuance. A persistent spread does not automatically mean Western paper pricing is fake in every sense. It means the Western benchmark can be late when immediate physical demand is doing the real price discovery. That is a huge difference. If you understand that, you stop waiting for a dramatic headline to validate what the market structure is already whispering. What this means for you is not that silver must instantly jump to the highest Eastern print everywhere. It means your ounce math should include a premium scenario, not just a spot scenario. On 25 ounces, a $10 repricing is $250. On 50 ounces, it is $500. On 91 ounces, it is $910. On 100 ounces, it is $1,000. If the market instead starts to reflect something closer to that $17 East-West spread, the numbers get much bigger very fast. The downside of waiting is not only missing a move, it is being forced to buy back the same ounces at a different market structure. Here is where the East versus West framing becomes unavoidable. The East is not waiting for permission from a paper benchmark. It is doing what physical buyers always do when trust in screen pricing weakens: accumulate bars, pay for immediacy, and secure supply. The West is still acting as if quoted liquidity is the same thing as available metal. That is why I call this paper suppression, or at minimum paper lag. The benchmark can stay lower than physical reality, longer than seems rational, but only as long as enough people accept the paper view. Once actual delivery and actual replacement costs matter more, the lag starts to close. And this is the personal implication section, because this channel is not about abstract macro drama. If your stack is 10 ounces, you are deciding whether to begin before late April logistics potentially tighten further. If you hold 25 ounces, you are already at a size where a spread change matters more than most monthly savings plans. If you hold 50 ounces, your next move should be based on replacement cost, not comfort from a futures quote. If your number is 91 ounces, the math is staring you in the face because the bag size in this setup almost mirrors the Eastern bid. If you hold 100 ounces, the exact question is this: are you anchoring to a Western paper price that may be late? And if you hold 250 or 500 ounces, you are effectively long the possibility that physical accumulation in the East forces the West to admit its benchmark has been behind. Tell me your ounce count in the comments and whether you are seeing this as a buy the dip paper market or a secure the metal physical market, because that distinction is the whole game right now. At this point, the evidence stack is pretty straightforward. A visible East-West price gap, a deep COMEX drain narrative, a late April logistics catalyst, and a market structure where physical accumulation in the East is colliding with paper complacency in the West. If you want silver analysis built around actual market mechanics instead of recycled headlines, subscribe, because this is where the important tells usually show up first. Now let me resolve the final piece. Now you see the full picture. That gap between paper and physical isn't random, and here's what it means for your metals. Each of the contradiction. The market is not really saying silver is worth $74 and $91 at the same time. The market is saying an ounce promised through a Western paper machine can still be priced one way, while an ounce wanted now in the East can be priced another way. Those are not equal products during a tight window. The hidden implication is that the cheaper price may not be the real bargain. It may be the delayed price. Now, the payoff is clear. By the end, the viewer should understand why Dubai/Singapore silver $91 versus $74 gap plus COMEX drain changes the next move and what to do with their own position. Translate the setup into what it means for a physical stacker with a real ounce count, not just market commentary. That is the part most people miss, and it's the reason this setup matters beyond the headline. So, what should you watch between now and April 29th, 2026? Watch whether Eastern physical bids stay firm. Watch whether the COMEX drain conversation intensifies instead of fading. Watch whether premiums remain sticky even when paper silver looks calm. And most of all, watch whether the West starts moving only after the East has already paid up again. If that keeps happening, the message is clear. Physical accumulation is leading, paper pricing is lagging, and the silver squeeze people keep arguing about may not begin with a headline. It may begin with the market quietly admitting that 1 ounce was never really priced correctly in the first place,